Stop whatever you are doing right now. Just listen. Because what I am about to share with you in the next 20 minutes could be the most important financial conversation you have this entire year. Not because I want to create panic, but because the market is standing at a crossroads and most people have absolutely no idea what is coming on Monday. My name is Zara. I study markets, monetary policy, and the psychology of investors who build real wealth across decades. I am not here to give you hot tips. I am here to give you something far more valuable: understanding. Because understanding is the only thing that will protect you when the noise gets loud. And right now, the noise is about to get very loud. Let me take you back to a moment that changed the way I think about markets forever. It was a quiet Thursday afternoon. I had just made a decision I felt confident about. I had put a meaningful portion of my savings into a position I believed in deeply. I had done my analysis. I had read the reports. I had studied the charts. Everything made sense to me. I felt completely prepared. And then the Federal Reserve spoke. Within 48 hours, that position moved against me in a way I had never anticipated. Not because my analysis was wrong, not because the company I believed in had changed, but because the single most powerful financial institution in the world had shifted its signal, and I had not been watching the right thing. That experience cost me real money, but more importantly, it gave me a lesson I have carried ever since. The Federal Reserve is not just a bank. It is the conductor of the entire financial orchestra. Every asset class you can think of, stocks, bonds, real estate, gold, currency, moves in relationship to what the Fed does and says. When the Fed makes a move the market does not expect, everything adjusts. Sometimes slowly, sometimes violently. This weekend, that adjustment is coming. Now I want you to understand something clearly. I am not saying the sky is falling. I am not telling you to sell everything by Sunday night. What I am saying is this: an informed investor and an uninformed investor sitting in the same market will have two completely different experiences of the same event. One will react with fear and make decisions they deeply regret. The other will respond with clarity and find opportunity where others only see chaos. I want you to be the second type of investor. That is the entire purpose of this conversation today. The Federal Reserve manages the cost of money through interest rates. When rates rise, borrowing becomes expensive, businesses slow down, investors shift away from risk, and asset prices fall. When rates fall, money becomes cheap, businesses expand, investors reach for growth, and markets often climb. This cycle has played out for decades, and those who understand it carry a permanent advantage over those who do not. Right now, after one of the most aggressive rate cycles in modern history, the Fed is about to send a new signal. The market is watching. The world is watching. GK announced will move prices across every asset class you care about. In this video, we will cover 4 things: the psychology behind Fed-driven fear, how these decisions actually GK through your portfolio, the mindset of investors who survive and grow through these moments, and a clear framework you can use every single time the Fed steps into the headlines. This is the foundation, and every strong structure needs one. Most investors make one critical mistake during Fed announcements. GK watch the market move and then GK react to the movement. They do not understand why the market moved. And because they do not understand the why, they cannot predict what comes next. They are always one step behind, always chasing, always surprised. Today I want to walk you through exactly how a Fed decision travels through the economy and lands directly inside your portfolio. Once you see this chain clearly, you will never be blindsided in the same way again. It starts with the announcement itself. The Federal Reserve meets regularly throughout the year to review economic conditions and decide on monetary policy. At the end of each meeting, they release a statement. Inside that statement are two things the market cares about most: the rate decision itself, meaning did they raise, hold, or cut, and the language, the tone, the forward guidance. What they say about the future matters sometimes even more than what they actually do today. Here is something most people do not know. By the time the Fed actually announces a rate decision, the market has usually already priced it in. Professional traders, institutions, and algorithmic systems spend weeks analyzing data and placing bets on what the Fed will do. The market moves in anticipation, not just in reaction. So when a decision is announced, the real question is not what did they do? The real question is, what did they do compared to what the market expected? That gap, the difference between expectation and reality, is what causes the violent moves. If the Fed signals a cut, but the market expected a bigger cut, stocks can still fall even though rates went down. If the Fed holds rates but speaks more aggressively about future hikes, bonds can sell off hard. If the Fed cuts more than expected and hints at further cuts ahead, markets can rally sharply in a single session. This is the game being played at the highest level, and if you do not understand it, you will always feel like the market is moving irrationally. Now let us talk about how this reaches your actual investments. When the Fed changes rates or even signals a future change, the first thing that moves is the bond market. Bond yields adjust immediately, and bond yields are the foundation on which all other asset prices are built. When yields rise, the present value of future earnings falls. That means growth stocks, companies whose value depends heavily on profits they will make years from now, get hit the hardest. Technology companies, early-stage businesses, high multiple stocks. All of them become less attractive when bond yields rise because suddenly there is a safer alternative paying real returns. Real estate follows a similar pattern. Mortgage rates are tied to bond yields. When yields rise, mortgage rates rise, home affordability falls, demand slows, and property prices come under pressure. Gold and commodities respond to the dollar, which responds to rate expectations. When the Fed is hawkish, meaning tough on inflation and willing to keep rates high, the dollar strengthens. A stronger dollar makes gold and commodities priced in dollars more expensive for the rest of the world. Demand falls, prices fall, and currencies across the globe shift based on the interest rate differential between countries. When U.S. rates are high relative to other nations, capital flows into dollar-denominated assets. Emerging market economies feel pressure as their currencies weaken against the dollar. This is the chain: Fed signal, bond market, dollar, then everything else. Understanding this chain does not mean you can perfectly predict every market move. Nobody can. What it means is that when you see volatility, you understand its source. And when you understand the source, you can ask the right question. Is this a temporary disruption or a fundamental shift in the direction of monetary policy? That question is the difference between a panic sell and a strategic hold, between locking in a loss and staying positioned for a recovery. Monday morning, when the market opens and the reaction to this Fed move begins to play out, I want you to watch the bond market first. Watch the 10-year Treasury yield. That number will tell you more about what is actually happening than any headline you will VDK. If yields spike sharply, expect GDK stocks and tech. If yields fall, watch for a broad market rally. If yields barely move, GDK largely got what it expected, and the volatility may be short-lived. You now know what most retail investors never bother to learn, and knowledge, as we are about to explore, is only the beginning. You can understand everything GDK explained in Part 2, every word of it. You can know how the Fed chain works, how yields move, how asset classes respond. You can have all of that knowledge sitting perfectly organized GDK, and you can still lose money on Monday. Not because the market surprises you, but because your own psychology betrays you. This is the part nobody wants to talk about, because it is uncomfortable, because it forces us GDK. But I promise you, the biggest risk you face in a volatile market is not the market itself. It is the person watching the market. Let me describe the pattern I have seen repeat itself over and over again with experienced investors and beginners alike. The announcement drops. The market opens on Monday. Maybe it gaps down sharply, red everywhere. The financial news channels are running dramatic headlines. Social media is filled with people sharing their losses and warning of crashes. The fear is real. It is visible. It is contagious. And in that moment, the average investor does one of two things. Either they freeze completely, paralyzed by the noise, unable to make any decision at all, or they panic. They sell. They tell themselves they will get back in when things calm down. Both of these responses are driven by the same force: loss aversion, the deep, wired human instinct to protect what we already have, even at the cost of what we could gain. Here is what the research consistently shows. Investors who exit the market during periods of high volatility almost always miss the recovery. And the recovery, in most cases, happens faster than anyone expects. The single best days in the market historically tend to cluster right around the worst days. If you are not invested during those recovery days, your long-term returns suffer dramatically. The second trap is what I call narrative capture. This is when the story being told in the media becomes so compelling, so convincing, so emotionally resonant that you begin to make decisions based on the story rather than on the data. Every major market event comes with a narrative. The Fed move this week will come with one too. Pundits will explain it with great confidence. Commentators will tell you exactly what it means and exactly what you should do. Most of them will be wrong. Not because they are dishonest, but because the future is genuinely uncertain, and narratives are always built on incomplete information. The third trap is comparison anxiety. This is particularly dangerous in the social media age. You start seeing posts about people who sold at the top, or who positioned perfectly for the Fed move, or who made significant gains while you sat still. And you start feeling like you are missing something, like everyone else knows something you do not, like you are always the last to act. This feeling drives some of the worst financial decisions human beings make. Buying into momentum at the top because everyone else seems to be winning. Selling at the bottom because everyone else seems to be panicking. Following the crowd precisely when the crowd is at its most irrational. The fourth trap is recency bias. Whatever has happened most recently feels like it will continue forever. If the market has been rising for months, it feels like it will keep rising indefinitely. If it falls sharply for 2 days, it feels like collapse is certain. Our minds are built to extrapolate the immediate past into the future, and in markets, that instinct is almost always wrong. So how do you fight these traps? You fight them the same way you fight any deeply ingrained habit, with awareness and with a pre-decided plan. Before Monday arrives, I want you to do something simple. Write down your current positions. Write down why you own each one. Write down your original thesis for owning it. And then ask yourself one honest question. Has the Fed announcement actually changed that thesis? Or has it only changed the price? Because price and value are not the same thing. They converge over time, but in the short term, they can diverge dramatically. and volatile, emotionally driven markets are exactly where price and value separate the most. If your thesis has not changed, hold your position. If your thesis has genuinely changed, exit with discipline, not panic. That is the difference between a decision and a reaction. There is a certain type of investor that I have come to deeply respect. Not the flashiest, not the loudest, not the one posting the biggest gains on social media during a bull run. The one who is still standing after every storm. The one whose portfolio looks essentially the same during a panic week as it does during a euphoria week. The one who does not need to check prices every hour because they built something designed to survive uncertainty. I want to talk about how that investor thinks, because thinking is where everything starts. The first thing this investor understands is that Fed-driven volatility is not an anomaly. It is a feature. It is a permanent, recurring part of how markets work. There will always be a Fed announcement. There will always be a surprise. There will always be a Monday where something unexpected happens and prices move sharply. Preparing for this reality is not pessimism. It is wisdom. The second thing this investor understands is the difference between price risk and business risk. When the Fed announces something that shakes the market, prices fall. But the businesses behind those prices, the companies with real revenues, real customers, real products, those businesses do not change overnight because of a Fed announcement. If you own a piece of a genuinely strong business, short-term price movement is noise. What matters is the long-term trajectory of the business itself. This distinction sounds simple, but it is extraordinarily difficult to hold on to when you are watching the value of your portfolio fall in real time. That is why it must be decided in advance, not in the middle of the storm. The third principle is position sizing with intention. The investors who get destroyed in volatile moments are almost always the ones who are over-concentrated. They put too much into one position, one sector, one idea. And when that idea gets hit by a Fed surprise, there is no cushion, no balance, no part of the portfolio moving differently to offset the pain. Real long-term wealth builders think in terms of the whole portfolio, not individual positions. They know that different assets behave differently in different environments. Some things rise when rates fall. Some things hold their value when markets fall. Some things outperform during periods of uncertainty. Building a portfolio with that kind of internal balance is not about settling for average returns. It is about creating resilience. Resilience is what allows you to stay invested long enough for compounding to do its work. And compounding is everything. It is the one financial force that rewards patience above all else. The fourth principle is liquidity management. One of the most powerful things you can do before a major market event is know exactly what you own, how liquid it is, and whether you have enough cash or near cash assets to handle any short-term disruption without being forced to sell long-term positions at the wrong time. Forced selling is the enemy of wealth building. It happens when people are too invested and face an unexpected need for cash exactly when the market is down. Having a buffer, a simple cash reserve, removes that pressure completely. It transforms you from a reactive participant into a patient observer. And patience, I cannot say this strongly enough, patience is not passive. Patience in investing is an active, deliberate choice made every single day that the market gives you a reason to abandon your plan. The fifth principle is that this investor maintains a written investment policy. It does not have to be complex. It simply answers a few questions in advance. What do I own and why? What conditions would cause me to sell? What is my time horizon? What level of loss can I tolerate without changing my behavior? What is the plan if the market falls 10%, 20%, 30%? Having those answers written down before the storm means you are never making those decisions in the middle of the storm. You are simply following a plan you made when you were calm, rational, and thinking clearly. Monday will come. The market will react. Prices will move. People will be scared or excited or confused. And through all of it, the investor with a plan will simply sit back, review their written notes, confirm whether anything fundamental has changed, and make one deliberate decision rather than a dozen emotional ones. That is not luck. That is discipline built in advance. We have covered a lot of ground together today, and I am grateful that you stayed with me through all of it. But I want to use this final part to do 3 things: give you a warning, give you a framework, and leave you with something you will carry forward long after this video ends. First, the warning. I have watched enough market cycles to know what is about to happen this week. Not in terms of price direction. Nobody knows that with certainty. What I know is what will happen to a large group of investors emotionally. Some will see the Fed move and feel vindicated in whatever position they already believed in. They will become more aggressive, more leveraged, more convinced that they have figured it out. These are the investors who tend to get hurt the most, not by the initial move, but by the second and third wave that follows when their confidence turns to overexposure. Others will see early volatility and exit. They will wait for clarity. They will tell themselves they will get back in when things settle down, and they will watch the recovery happen without them, again. And a smaller group, the ones who prepared, who had a plan, who understood the mechanism, who managed their psychology, will simply stay the course. They will not have the most exciting story to tell on social media, but 6 months from now, a year from now, 5 years from now, they will be the ones still standing with a portfolio that reflects decades of patient, disciplined, informed decisions. I want you to be in that third group. That is the only group that builds lasting wealth. Now let me give you the framework. 5 simple questions to ask yourself every single time the Fed moves and markets react. 1. What did the Fed actually do, and what did the market expect? The gap between those 2 things is what is driving the price movement. 2. Has anything fundamental changed about the businesses or assets I own? Not the price, the underlying value, the actual business. 3. Am I reacting to data or to emotion? Am I looking at numbers, or am I responding to headlines, social media, and fear? 4. Does my current portfolio have the resilience to handle this volatility without forcing me to make permanent decisions about temporary conditions? 5. Does my plan account for this kind of event? And if so, does the current situation actually require me to deviate from that plan? If you can answer those 5 questions honestly and calmly every time the market shakes, you will never make a truly catastrophic investment decision. You will make mistakes. Everyone does. But you will never make the kind of mistake that wipes out a decade of building. And now, the takeaway. The Federal Reserve is powerful. Its decisions move every market in the world, and that will never change. What can change is how you relate to that power. Whether you are at its mercy, moved by every announcement like a leaf in the wind, or whether you understand it deeply enough to use its cycles to your advantage. The investors who built real, lasting wealth did not do it by predicting every Fed move correctly. They did it by building portfolios resilient enough to survive the wrong predictions. They did it by staying in the game long enough for the right decisions to compound. They did it by refusing to let short-term fear override long-term strategy. This weekend, while others are anxious, I want you to be prepared. While others are reacting, I want you to be positioned. While others are asking what will happen on Monday, I want you to be asking what kind of investor I am committed to being for the next 10 years. Because that question, answered honestly and acted upon consistently, is worth more than any Fed prediction ever made. My name is Zara, and I will see you on the other side of Monday. Stay calm, stay informed, stay the course.